something we like to ask the debuts in the ETF industry is why now? What brought you to this wrapper now when it comes to why implement your strategy here?
Well, why now is because we live in a world where after COVID, the risk of stagflationary shocks that lead to higher inflation and lower economic growth are becoming more severe. And these types of stagflationary problems are going to be more serious during a Trump administration. If you think about the impact of tariff protectionism and trade wars, the impact of restriction to migration on the supply of labor, deficits and tax cuts that are unfunded, attempt to weaken the dollar, attempt to interfere with the Fed, getting out of the Paris Accord and worsening global climate change, all these factors, economic theory would suggest they would lead to higher inflation, lower economic growth, and therefore traditional safe assets that hedge against those risks, like long duration fixed income, don't do well in that type of environment. So you need a different type of asset allocation to hedge yourself against a variety of economic risk, inflation, the basement of fiat currency, the dollarization, geopolitical and environmental risks.
Thank you for answering that. Clearly, it's tied to your economic outlook, and we can dig into that a little bit later on. But Reza, I want to bring you into the conversation as well. Why the ETF wrapper? Why is that the best format for really articulating this view?
Well, the origin of the Atlas program was out of the national security landscape back in 2017, when we were evaluating some of the risks that were kind of upcoming, in our view, geopolitical risks, climate risks, asymmetric risks, sociopolitical risks. And we felt that it was necessary to build a more resilient U.S. Treasury alternative. And the Trump administration actually came up with an idea of a gold-backed Treasury instrument, which we took upon ourselves to commercialize because the Treasury Department couldn't do so themselves. It would cannibalize their existing market, and they didn't have enough gold to really create much of an issuance. So the origin of this story came about by trying to create that Treasury alternative that could withstand the risks that we were forecasting. And so therefore, we thought the ETF wrapper would be the best solution, especially because we dynamically allocate these assets as we see market signals coming in, whether growth or inflation risks. So the ETF was just an ideal, liquid, and very well-regulated and well-structured instrument.
All right, Nouriel, this is a question for you. We talk about inflation, right? In 2022, inflation went up, Fed raised rates, and that caused treasuries to go down, right? A lot of bonds went down with stocks that year. The 60 and the 40 both fell. You have 50% treasuries in here, and I did notice a triple leverage bear ETF in there. Can you talk about managing that kind of a situation where inflation causes rates to go up, bonds to go down? How do you protect this treasury exposure?
Point is that we are going away in our portfolio from long duration fixed income and treasuries, because as you pointed out, when there are economic shocks that are inflationary, long bond yields go higher, the price falls, but also equity prices like 2022 go down. So the traditional safe asset is long duration treasuries doesn't work in a situation in which inflation is rising. That's why in our portfolio of treasury, we stay completely away from long-term treasuries, and all our allocation of treasury is short-term treasuries and tips that actually do well in times where inflation is higher and you have those types of economic shocks. So the point is the traditional safe asset that is negatively correlated with equities in a 60-40 allocation doesn't do well in a world of higher inflation, like we saw in 2022, 23, even this year. Therefore, you need an alternative. An alternative combines things that do well when inflation is higher. Short-term treasury, tips, gold, commodities, and environmentally sustainable REITs.
Nouriel, that's really interesting. And just to draw a bow on that point, it sounds like you're positioned basically for a curve steepener, that you have all this exposure to the short end of the Treasury curve, but positioned for the long end yields to go higher.
Yeah, in our view of the world, over time, all the inflationary shock that I described before implied that long bond yields are going to be higher, both in nominal terms and in real terms, as we're going to have tariff, migration restriction, independence of defense challenged, and budget deficits are run away. Therefore, the traditional safe asset doesn't do well. In 2022, bond yields went from 1% to 3.5%, and 10-year Treasury lost more than S&P. S&P fell 15%, while 10-year Treasury lost price by 20%. So in a world in which average inflation might be 5% rather than 2%, bond yields may be closer to 7-8% rather than the current 4+. And therefore, $20 trillion of treasuries that the traditional safe asset will be subject to massive price risk, 30-40% losses. That's the kind of world we're thinking. Not high inflation, not hyperinflation, but even a rise in inflation from 2 to 5, 6 has a massive damaging effect for the traditional long-duration fixed income asset.
So this will be an actively managed fund. Nouriel, how often do you anticipate making changes to their portfolio?
Not very often. This takes a long-term view that actually there's forces that's stagflationary. So first of all, is partly a quantitative approach. We look at states of the world in terms of growth and inflation and determines allocation. There's an element of it that is slightly discretionary, but we think about optimizing maybe once a month, not more often than that.
This is a question for Reza. When you think about the stock market, it seems like Trump wants stocks up. He brags about the stock market a lot. And if they go down, you think he would just bend over backwards to make stocks go back up. In your opinion, do you see that not happening this second term, or do you think that this ETF is needed just in case the stock market, kind of goes its own direction?
Well, there's a tremendous amount of risks offshore that we need to look at. This Lebanon-Israeli, for example, truce agreement may just create more risk against a war against the Iranians and the Israelis, which obviously has effects on the oil supply that comes out of the Persian Gulf. These kind of risks do significantly impact the stock market, especially as that oil goes to China, and there's obviously some other risks associated with the South China Sea. And so we don't see these events being positive for the stock market, and we see this instrument, and this instrument is designed to do so, doing well at times such as this. That's why we launched it at this time frame.
And Reza, I have another question for you. I thought an interesting detail was that this ETF was launched through Goldman Sachs ETF Accelerator Program. It's not quite a white label, but for those listening who maybe aren't familiar with the concept, basically Goldman Sachs helped you do the back office stuff, as I believe it, or understand it, to get this ETF to the masses. Can you talk us through why you went with that setup, for example, rather than hiring out an ETF team?
Yeah, in 2018, when we came off the back end of working through the alternative Treasury instrument idea through the Trump administration and the national security think tank we were working through, the Goldman Sachs team took it upon themselves to help us devise this program as a more resilient U.S. Treasury instrument. They built an index initially. We built an annuity with them. And we just felt their team was really strong. They're really focused on national security. They're focused on resiliency. They've got a very strong relationship with Washington. And they've got a fantastic team at the ETF Accelerator. Lisa Mantle, Steve Sachs. These are really, really strong teams that we rely on to execute these trades. And we think that there's more work to be done underneath the illiquid portion of this ETF at a time and a place when the scale allows it. So the platform is very strong, but also the connectivity to the other parts of Goldman and their natural inclination to be more focused on national security and resiliency and economic security matters made them a natural choice. We're very proud to be working with them.
And Nouriel, when you think about this ETF, the big market for ETFs is advisors. Financial advisors are like 70% of ETF users. What does this replace for a typical 60-40 advisor? Is this going into the bond portion or the equity or maybe some other alternative portion they might have?
No, it's a substitute for the bond portion because, as I pointed out, the traditional defensive asset is long-term Treasury doesn't work in a world in which inflation is going to be gradually higher, bond yields are going to be higher, prices are going to be lower for those bonds at the time where there could be correction in equity markets. The whole point of 60-40 is based on a negative correlation between bond prices and equity prices. Risk on growth, equity do well, bond prices fall. Risk off recession, bond prices go higher, the yield goes down, equities do worse. But that works only if inflation is low and stable. Instead, in a world in which gradually inflation goes higher, you lose on the equity portion of your portfolio, and you lose also on the bond portion of your portfolio. So when you lose on the bond portion of your portfolio, you want to have an asset that is actually truly defensive when interest rates are higher, because either there is higher inflation or bigger deficit than that. And so it's an alternative to the bond part of your portfolio, the defensive part of your portfolio.